Okay, so Shane, one of the big issues we were dealing with this time last year, was the ANZ building going up, the creation of quite a bit of backfill space back in the CBD. What's happened to that backfill space, and how do you see it performing in the next 12 months?
The ANZ space has been quite well received and probably hasn't had the impact that we thought it made this time 12 months ago. But equally importantly, I think a lot of the development supply that came online either late 2009 or is about to come online, it's pretty much all been accounted for. So moving forward in 2010, we're pretty much limited to large tracts of new supply, being the balance of ANZ space at 530 Collins Street and 321 Exhibition Street. Now, they're both good quality offerings, and I wouldn't expect they're going to be around this time next year.
Okay, so do you think the conditions are going to be there? I mean, you saw the forecast for rental growth. Do you think those conditions will be conducive in the market in the next 12 months to actually increase rents?
I think we'll start to see some rental growth, absolutely, and I think we'll also see a reduction in incentives. So certainly in 2010, I think we'll see some positive movement for landlords, and I think that'll be more pronounced in 2011 through to 2012.
Okay, let's go back to you, Mark. Without debt, I mean, debt's obviously a key part of doing deals, especially the bigger deals.
Yeah, sure.
What do you think the role will be of debt in deal making in 2010?
Oh, it's still an important factor. It's a big part of a real estate transaction. But I think it's not just debt; it's cost of capital as well. And there's a big range now in terms of what capital is costing different investors, different active investors in the market. So I think it'll be a bit of a story about the haves and the have-nots, and there'll be some differing prices accordingly, because obviously people are going to price assets partially dependent on their cost of capital. So it's going to be a matter of finding those people who've got a lower cost of capital, potentially even some of the international funds that are buying with 100% equity, and finding those buyers and driving value from there.
So do you think there'll be enough activity in the market to see some yield compression, from what you're seeing and the volume of inquiry coming in for properties in Melbourne?
Definitely. I mean, we've got a much wider range of buyers in the market now. We had, it's sort of been bashed just in the press. There was a lot of international buyers coming through, Melbourne particularly, chasing yields and stronger income profiles through the CBD. We had the private base in Melbourne, which is traditionally very strong, and they were active, particularly 2008, 2009. And now we've got some of the domestic funds coming back into the market as well. I mean, the phone's been ringing from them. They're really starting to look closely at Melbourne for all the reasons that you talked about earlier, in terms of the rental growth profile and cheapness and capital values.
Okay, so it's going to be a busy year.
Yeah, I think so. Yep.
Okay, let's turn to a different point now. Mandatory reporting of Green Star rating and neighbours requirements. It's a new issue, and it's going to be introduced into the market this year. How do you see it impacting on the leasing side as well as on the investment market?
From a leasing side, I suppose it's going to create more work for asset managers. It's more reporting, and it is mandatory. So it's probably not welcomed by landlords, but it is a natural extension of tenant demand. So I think it just reinforces to landlords that the ESD, the importance of ESD, isn't going to go away, and it is something that needs to be addressed. Investment
activity, I mean, it's been front of mind, particularly the last couple of years, and I think that'll be true going forward. What we're finding, looking at assets with strong green credentials, is that generally you're getting longer lease terms and you're getting better quality tenants, and ultimately that's going to drive value going forward. So again, it's a bit like the cost of capital scenario. It's the haves and the have-nots, and I think it's going to be a very, very important way to drive value out of your assets going forward. And there's no hiding from it now that you've got a legislation that means you've got to tell everyone about it.
Okay, so wrapping up now, let's pull out a few key points, a few key pieces of advice for the year ahead from the leasing front, as well as opportunities in the market, Mark.
I think from a leasing perspective, we should see steady and sustained growth in Melbourne, not only in 2010 but over the next few years, which is something that's long overdue. I think opportunity-wise, anybody that is able to deliver a decent tranche of stock in 2011, 2012, even early 13, will be sort of very well placed to capitalise.
investment-wise, I think it's all about chain story. It's that leasing, it's the income again. It's targeting 11 but 12 particularly, we think. It's looking at rent profiles that were really economic rents that were that 350, 360 in the last construction cycle that are now 400, 450, going to 500 on the forecast. So you're buying in at lower capital values than you're going to. I mean, you're buying in at $4 grand, $4 a metre, and probably tracking towards 7,000. I mean, that's the play for Melbourne in the next 5 to 6 years.
Okay, look, they're terrific ideas. So thanks very much, Shane and Mark. So please join me in thanking the guys who come. Now we're going to move on to the non-CBD office markets, looking at the St Kilda Road, the South Bank, and the city fringe outer suburban markets. Now, let's see. So I'm reading. I can't see the slides. Yeah. Here we go. Thank you. I guess the capital value falls outside the city have actually been bigger than in the CBD. And it's tended to attract more attention. It's tended to lead to a more active investment market. And you can see here some of the capital value falls we've tracked over the last sort of 18 months to 2 years. The St Kilda Road falling 25%, South Bank about 20%, the sort of the city fringe areas and the outer east about 20%, and Mulgrave less at about 15%. So it has certainly created an environment where there's opportunity, and the private investors have made the most of that. And that's not going to go away straight away. Obviously values will start to rise more gradually, so there's still an opportunity in the suburban areas. You can see here the chart, the trend in trading activity. It's certainly fallen, but it's fallen back down closer to sort of a long-term average. And private investors have been making up about 60% of trading activity in the non-CBD office markets. The situation with the sort of fundamentals in these markets is quite different. I mean, really, in summary, St Kilda Road is the one market where we do see vacancy staying higher than we would like to see. It's around 11% now. The market contracted, actually shrunk by about 20,000 square metres of occupied space in the second half of 2009. So that pushed vacancy up to about 11.3%. These numbers are as of January, so our forecast actually calls for a slight increase over the next 12 months in vacancy in St Kilda Road, and that's despite, of course, really no new construction activity down there. It's really caused by some tenants moving out of the market over the next 12 months. If you turn to the South Bank, the city fringe and the outer suburban markets, we've seen quite a bit of construction activity in these areas, some of it speculative. It'll take a little while for that to be absorbed, and that absorption process will continue, we think, more aggressively now into 2010. That will start to bring vacancy down. And interestingly, 12 months ago we said about the sort of suburban markets, and we often talk about the suburban markets and new opportunities and pushing back the frontiers, and we said, well, last year, 2009 would not be the year to push back the frontiers. It's not the development year. But here we are 12 months later, we're really quite surprised to say, well, actually, it is time to get those plans out, dust them off, and start looking at construction activity once again. So I've lost my slides here again, unfortunately. So I might take a wander downstairs for a moment. No? So thank you. So the vacancy situation is forecast to fall in each of the non-CBD office markets except St Kilda Road. That's an important theme. And the other theme really coming from this sort of analysis is that yes, the development cycle is probably not that far away.